Hello everyone, my name is Dave Danikowski with the Danikowski team at Guaranteed Rate. And today I want to talk about PMI, which stands for Private Mortgage Insurance. Sometimes you'll just see it listed as MI, Mortgage Insurance, but it's the same thing. Unlike homeowners insurance that you have to have a policy in place when you purchase a home that covers the contents of the home and covers the home itself, mortgage insurance is actually there to cover the lender. It actually protects the lender in case you default on your mortgage and the property becomes foreclosed. So this is not to be confused with mortgage protection insurance, where a homeowner can purchase insurance that will continue paying their mortgage in the event that they die. But we don't recommend that insurance. We recommend that you have a life insurance plan and policy in place to cover that situation. So lending is all about risk, and the mortgage insurance helps lower the risk for the lender. The general rule of thumb is you have to have a minimum of 20% equity purchasing a home to where mortgage insurance will not be required by the lender. So just take a case of a $200,000 home, that's $40,000. Well, a lot of first-time home buyers do not have that kind of money to put down. They're getting in there with 3% or 5% down. So the lender will require them to purchase mortgage insurance on top of their mortgage. So, the 20% equity, when you're paying your mortgage and if real estate's going up and increasing every year, you can gain that equity pretty quick. In fact, at a 4% return rate, which is conservative, on the property going up every year on that $200,000 home example, and if you put 5% down, it would take 5 years and you would have 20% equity already built up into that house. So paying mortgage insurance comes in many forms. You can pay it monthly, you can pay an upfront fee, you can pay some upfront and some monthly, or you can have the lender paid insurance. So if the lender does the paid insurance, they will typically have a higher interest rate to compensate for the cost of their of paying that insurance. But on that example of the $200,000 home, I will give you an example of what it would cost. So mortgage insurance, it varies greatly depending on the purchase price of the home, how much you're putting down, credit score, which means a lot, and the debt to income ratio. So on that $200,000 example home again, if you put 5% down and you had a 750 credit score, you would be expecting upfront, if you were to pay it upfront, maybe about $1,800. If you were to pay it monthly, about $42, $45 a month in that example, okay? So when does mortgage insurance actually end? So the CFPB actually has listed that mortgage insurance is required to end when it reaches 78% of the amortization value of the original mortgage note, or if or half the term. So if it's a 30-year term, it would be half of that, 15 years, whichever comes first. Now that 78%, the key there is it's based off of the value that the home was purchased at in the beginning. It takes no consideration for the increase in equity over time. So their amortization schedule and when it will drop off is going to be much farther down the line than if you wanted it to drop off earlier. So what happens a lot is people will end up refinancing once they have that equity built up. But if you like your rate, you can go ahead and you could just get an appraisal done on your own and then submit it to your mortgage servicer, and see what procedures they have, because they'll have to review it, review the value, they'll see what your balance is. Once there's 20% there, then they can drop off the mortgage insurance off your mortgage payment. So, well, I hope you found this video interesting and you learned some things about mortgage insurance. If you have any questions, you can always contact us direct. Thank you.